Well, all indices as we speak have moved into the green, but let's talk about another set of numbers coming in. Arvind Fashions, good set of numbers. In fact, the higher retail mix led to 500 basis points gross margin expansion for the company as well. But consumer demand continued to remain soft in the second quarter, understandably, as the festive season has moved into the third quarter as well. So we'll talk about the numbers and the outlook going forward. We have with us Kulin Lalbhai, who's the Vice Chairman and Non-Executive Director of Arvind Fashions. Kulin, always a pleasure speaking with you. Wish you, your team, and all the colleagues very happy Diwali and festivities. Speaking about Diwali and festivities, we're talking about demand, etc. We'll come to that. The big development that happened over the last 15 days or so was you selling the Sephora business. You were always sanguine on this. What led you to make this sale? And secondly, with this sale, where does your overall debt stand at?
You know, we have been constantly maintaining over the last 3 to 4 years that we want to build a portfolio of brands which delivers high return on capital employed and high free cash flows. And all the decisions on the portfolio have been made with that in mind. So with this transaction, we come to the end of our portfolio rationalization exercise. And, you know, the consideration which we have received will go towards, deleveraging further. So with this, our net debt levels will be lower than 300 crores. They'll be around 275 crores as we speak.
Okay, net debt will be around 275 crores. Kulin, thanks for joining in. But you know, this speaks about what the strategy of the business is, right? So far, you've been saying that you would try to avoid sort of selling any of the brands or not looking at value unlocking at the moment. But now you've decided to sell Sephora. So I'm just trying to understand any of your other brands that you are looking to do value unlocking in the near future? Anything that's on the cards?
No, not at all. In fact, we have been maintaining that post this transaction, all the brands we have, these are 5 very exciting brands. They are leaders in their category and they are set for very profitable growth and very high return on capital employed. So all the actions we have taken so far have been very focused on saying we want to put capital and management bandwidth into businesses which will generate high levels of ROCE. So the 5 brands which we have left will be brands we can aggressively now invest in terms of management bandwidth and capital. And we're very excited about, the value creation journey that this portfolio will deliver in the years to come.
All right, so let's talk about the value creation that this portfolio will do, at least in FY24. Earlier, you had said that revenue growth would be anywhere between 10 to 15%. Do you hold on to that? And for Sephora itself, are you happy with the consideration that you received? Because a lot on the street said that it was less than one-time sales.
Yeah, one has to look at the fundamentals of the business. It continued to be a loss-making business, whilst we are proud at the way we were able to scale the business up in terms of retail. It continued to lose 20 crores or so in terms of, a PAT. And, there is a certain free cash flow profile that the business would have generated over the next 5 to 10 years, which is what goes into a valuation. And we believe that it's fair. It's a little more than 2 times net asset value, which the business was sold for.
I wanted to talk a little bit about the other brands as well. You're doing some category expansion within the brand US Polo. You're adding some kids wear, you're adding footwear. Can you tell us what kind of scale up can you do here? What are the numbers that you're talking about in terms of revenues?
So US Polo is now close to a 2,000 crore brand. So it's one of the largest brands now in the category. And 25% of our sale is coming from these newer categories. And our growth rate in the newer categories tends to be closer to 20%. So I think it's a very exciting breakout opportunity that we have in US Polo. What a particular category that we are very excited about is footwear. We believe it's a very exciting opportunity that is emerging because India is casualizing now as far as footwear is concerned. The market is pivoting to sneakers. And we are emerging as one of the most successful sneaker companies in the casual space. So I think there is a lot of potential with these new adjacencies, and it all feeds into the mother brand becoming that much more exciting.
So let's talk about these categories itself. Kidswear and footwear were the 2 growth opportunities that you had spoken about earlier. How much do they comprise of in your current portfolio right now, and how much bigger can they get from here?
At an overall company level, it is between 10 to 15%. But in brands like US Polo, Tommy, and Calvin Klein, which is where we began our journey of adjacencies a lot earlier, it has reached 20 to 25%. And now we are about to launch many adjacencies in Arrow and Flying Machine. So I think overall, as a company, this might become 20 to 25% of the portfolio in times to come.
Okay, got it. 20 to 25% of the portfolio. So, on Arrow particularly, there was some losses that Arrow was facing during COVID times. Now you've returned to profitability, but just trying to understand what the overall size of the Arrow business is. What kind of growth can you see over there?
Arrow has had a strong turnaround journey. I think we've re-energized the brand in a 360 way. We've got fantastic new product. We've premiumized the brand. We've got Hrithik Roshan as our brand ambassador. We've got this excellent new brand identity. So I think the brand is kind of very green as far as its indicators are. What we need to now do is to expand our footprint. Our number of stores are still lower than they should be. So it's now a question of multiplying, the network. We are in the process of opening close to 40 to 50 Arrow stores this year. So I think we are well on track to scale up the brand, and we hope to move it towards 1,000 crore turnover over the next 18 months or so.
All right, 1,000 crores over the next 18 months for Arrow. Just to confirm, what are the return metrics of these adjacencies as compared to your core portfolio? When you speak about footwear, kidswear, all these things doing well, that expected to be around 20-25% of your portfolio. Do they give you better margins than all the other products?
So currently we have very healthy margins in our adjacencies. In fact, a business like footwear tends to have a slightly better profitability profile than the mainline. And our focus is to bring profitable growth. If you've seen our performance over the last 10 quarters, our EBITDA growth always outpaces our revenue growth. We've been improving our bottom line by 100 basis points every year. And that is happening because we are driving efficiencies and focusing on profitable growth. So these adjacencies will not be margin diluted.
So if, at the end, you're still sticking to your target of 10 to 15% top line growth for both FY24 and even for FY25, is that a realistic target, or could you even do better than that?
We are maintaining that the band of medium-term growth should be 12 to 15%. Now, at a quarterly level, you might have a few percentage points here or there on growth. But we believe that with our growth drivers, that's a fair growth trajectory. I mean, there could be periods where we might be slightly higher than that as well.
All right, take that point, Kulin. Always a pleasure speaking with you. Wish you good luck. And now that the portfolio is rationalized, hopefully the return ratios and all the other metrics will fall in place as well. 12 to 15% growth is what you aspire for. With that, we take a short break on the